Hello and welcome to Options Guy TV. My name is Brian Overby. I am the author of The Options Playbook, and I'll be your host for about the next 30 minutes here on Options Guy TV. Today is Monday, March 25th, 2024. The markets are open and rocking and rolling, and we're going to look at the trades that we put together on Friday. Now, on the last Options Guy TV, I got to admit, we kind of did something off the cuff where we as we went along in the show, we got some good questions on Friday. Decided to just do a very short-term paper trade, and we really did it to compare apples to oranges, I guess. We're going to look at what a butterfly looks like relative to a calendar spread in the SPX on a very short-term basis. Part of this is going all the way back to my conversation with Dan Sheridan from Sheridan Options Mentoring. He said that a lot of times they like to do a butterfly on the call side of things, and then a calendar spread on the bear side, uh, and do it all together. And this is just basically trying to take advantage of the way volatility works. So we wanted to get a little short-term bearish on Friday, and this was very short-term, so it was definitely a speculation trade that where we were looking at. And those it's not a staple of the portfolio. We're doing it honestly just to flat out learn about option trading. So we're going to look at those two trades today. But I went back and looked into the deep in the money call portfolio. And there's a lot of adjustments that need to be made. Now, that's inside the paper trade application, and because of that, I don't get all the quotes in the SPX. So I'm going to have to go out and adjust that position, but I think I'm going to wait till Wednesday, even though we got a lot to maintain. We need to roll some calls in Google. We need to roll some calls in the Charles Schwab position, which is now just Schwab position. And we also need to roll up the calls in NVIDIA because they've really had such a big run up. We put those calls on when the stock was around 400, and as of today, it's up again, trading right around 925-ish or so. I didn't actually look at 937, actually, somewhere in that range. So just a crazy time for NVIDIA, and we need to roll those positions up and stay long them. We're going to stay in that underlying stock, but we just need to manage some risk and take some of the money off the table and then go back in again. All right, so that's going to be Wednesday's show. In a nutshell, we're going to take that time to do this. These option contracts that we did in the SPX, we did them on Friday with a Wednesday expiration. So even though I do need to do some maintenance pretty bad in that portfolio, we're going to focus on these two trades. Okay, so here's optionsplaybook.com, and this is the strategy section. You find that under the categories and the option strategies. So the trades that we're going to look at are under the veteran tab, or seasoned veteran, actually. A couple of them are. And in this instance, we're going to go and look at what a horizontal trade or a long calendar trade with puts is in the SPX. So this is going to be one of them. And then let's go and pull up another tab, and we're going to also look at what's going on in the butterfly trade. Oops, need to go to option strategies, and we're going to look at that butterfly trade, and that's going to also be on the put side of things. So we're going to say, well, let's look at the way Dan likes to set it up if he wants to get bearish, and then let's also look at, if you wanted to do the butterfly, how they would work. Now, the profit and loss graphs to start with are very similar. So if we're looking at a long calendar spread with puts, some people will say that it's a poor man's butterfly. I've heard that before because there's only two legs in the trade. So here's where the setup is. You're selling a put strike A, buying a put at strike A, the same expiration date. So we call this one the front month, the one that we're selling, and the back one, we call that the back month with expiration 1 month later. We're only going to do it 1 day later. So SPX, there's so much premium in them because it's such a over a $5,000 index, and because of that, that adds a lot of juice into these option contracts. So a 1 day at the money option contract in the SPX has a lot of time premium in it still, with only 1 day remaining, and we're going to try to take advantage of that by setting up this put spread. But notice the profit and loss graph here. If we go to the butterfly, very similar, except for this is at expiration. So you have the hard defined lines at expiration. It's much more straightforward to understand break evens and profit and loss on a long butterfly spread with puts. You have limited and known downside, and you see that below the actual stock price. If the stock goes down, highlighting that, you have a limited and known situation on the downside and also on the upside. All right. So we're going to go back to the long calendar spread that's not defined, because one option contract is going to expire today and the other option contract is going to expire tomorrow. We're using puts because we wanted to get bearish in the marketplace, thought that just it's a little bit overdone, not that we're bearish on the market in general, just thought that the market was a little bit overbought on Friday and looked for a little bit of a downturn today. So now I'm going to tab out of this and I'm going to run over to the TradeHawk software. At least I think I am. There we go. And let's expand it. And I have right now, what I have set up is the calendar spread with puts. So if we're looking at this scenario, we have the SPX right now at 5,227. 5227 is kind of the way that I prefer to say it. And then I'm going to run over and look at where we were, which was, pretty close to this, but I have a screenshot of the trade. We were at 5235 when we put the trade on. So it wasn't on the close. It was at our normal 11 o'clock Eastern time. Somewhere around 11:15 is when we would put the trade on. The market is down $6. So it is going in the right direction. So it is helping us with this trade, but it's only a few pennies. We put the trade on for 105, and right now we see it trading at 115. We went quite a bit out of the money. We went all the way down to the one standard deviation move out of the money. Probably could have went a little tighter, honestly, but we were just doing it off the cuff. 5160 is where we were at, and we're up about 10 cents on that trade. Now, the one big thing that we want to highlight, this is actually the wrong side of it. Let's go back this way. 5160 here on the put side. Yep, there we go. And then on the call side, 5160 here. We're going to buy that one. So now on the situation, on the put side of things, we're going to be looking at trying to get out of this trade once we get a little bit of a jump up in the 160 put. So as this one expires on the near term, the 160 put, that we flip it. Okay. So in this instance, as this one is expiring, we're going to be long the 560 put for 1 day. So if we get a spike up in the VIX, which just didn't move much at all, the VIX is trading at 1315. If we get a spike up in the VIX, that would help our long option contract. And this is the concept of doing a short term option trade. If you're bearish, what you want to happen is you want this option contract to expire worthless, the one that you sold, and you want this option contract to explode in premium. So if we run back to this side of things, here's the 5160, and that one's accomplishing what we want to happen, in that the time premium has came out of that option contract. But now on the March 26th expiration, this option contract now is trading for 45 cents by 50 cents. Hence, the net debit, which kind of makes a little bit more sense, is 42 cents. So we put this on for 105. We need the market to come down in order for this one to pay out. Well, this one is expiring worthless. Now, I'm not worried about this option contract, the 160, exploding in price. It's 5 cents by 10 cents. And if we look at a lot of the option contracts around that strike, even if the market went down, they're all trading like 15 by 20. The 5200 is a good one to focus on. That's 45 by 50. That's a real option contract that still has some life. So if it did come down 20 points from this point in time, well, maybe you're going to have to pay 25 or 30 some cents on the trade. But if we look at the March 26th expiration, this is the one that we own. So if we get down to that level, let's say, so if we look at these contracts that are a little bit deeper in the money, or sorry, a little bit closer to where the money is at, if the market comes down and lands within that range, now we're looking at a buck 15 on the 5180, 5185, or a buck 55 by buck 60 in that range. So we still need a fairly substantial move, and $7 just is not going to cut it. So if we don't get a move by the end of the day, even though we were right on direction, we went too far out of the money on this trade, and we're going to have at risk that $1.05 that we put on that trade. Now, the concept of a calendar spread is that if you do put it on, you put it on as a calendar and you take it off as a calendar. You have the advantage here of, you could let this expire today. It looks like it's going to go out worthless at the 5160 level, and then ride this contract and have an entire day to be just long a put. Now, that's not the concept that you do in a calendar trade whatsoever, in that if you're putting this trade on as a calendar, you want to take it off as a calendar. So I would look to close this trade by the end of the day. Means we'll probably have to pay a nickel to buy back this put, and then we'll sell this for whatever we can. Now, we're at 42 cents now. We need about another 10 or 15 points to the downside to make this a viable trade in this long horizontal calendar. And we'll just let it ride. Like I said, it's a speculative trade, but it's very interesting to see the type of premiums that we paid for the option contracts on Friday, to see how much time decay we actually had over the weekend. So if we switch this up, and I'm going to send this to the what if calculator just so that we have it. And let's go back and look at the butterfly trade that we put on. So I'm going to have to pull that one up and look at my screenshot, and we'll set that one up for today. And we did a 15-point wide butterfly spread trade, and we paid 50 cents for it. And I'm feeling this trade's going to do a little bit better. Let's clear it out. But we still have one entire day for this trade to live. We did the March 26th expiration, and we went down. We did similar strikes in that we wanted it to get to 5160. So we bought the 5145s on the put side of things. We bought that. We sold two of the 5160s. And then we bought one of the 5175s on the ESC. Okay. Now we're at 27 cents. So we're down. We're doing better on the trade. We've lost less on the trade, which would make sense to me, because you're talking about a 1-day expiration here on the March 25th contract, and you're talking about a 26th expiration. An entire day is worth a lot of premium, right? So if you just look at the March 26th expiration here, not the 0 DTE, you're talking about 9 $9 by $11 on the ask. So you see a ton of premium on just the at the money option contracts with only 1 day remaining. Now, if the market comes down towards the 5160 level, well, that becomes the most at the money option contract. So we really needed to get down to 5175. That would have we would have needed a strong move to the downside. But you can even see these option contracts at 5190. That's got some juice in it still. 5185. That also has some juice. So if we want this trade to be profitable, we need about the same type of move. We need almost a 20-point move by the end of the day to be able to get somewhere within the range. If it is anywhere above 5175, well, then the option's going to go out worthless and the butterfly wouldn't be worth anything. We're down about 50 cents on the trade. We'll see where it ends up on tomorrow on Tuesday, and the going into that expiration date, and we'll see how it turns out. But we do need a bigger move to the downside for either of these trades to be profitable. We just went a little bit too far out of the money, bluntly, in order to make that works. Now, if you have any questions about the trades, feel free to put them in the chat box if you are on the YouTube platform, and I'll be happy to try to address those trades during the show. Now, a couple of things that we have to look at as far as the paper trades are concerned is Nvidia just won't stop. Let's see if it's moved up another $15 since the show started. All right, so we're at 961. We're up $18 already on the day. We're up another 2% on that trade. So we have some deep in the money calls, and honestly, we're way too deep in the money on them. So when we look at that trade, we're going to buy to close we're going to sell to close the option contracts that are at the 320 strike. So we bought a deep in the money option contract when we first put on our Nvidia position. Now it's way deep in the money because 320 strike, you're looking at a 960. And what we're going to do on Wednesday's show is we're going to buy back that option contract, and well, we're going to sell to close that option contract and then roll up and take some of the money off the table and reduce our risk again, but still stay long in the Nvidia position. And that's one of the ways that we're just going to have to approach it. So we've gone all the way out, and I'll highlight this, and I'm not going to run over to the paper trading platform just yet, but we have 300 days left in that position. And let me close this out, and I'll show you the trade that we're going to look at. And I'll tell you that I'm not too nervous to do it today. I don't feel like I have to do it today. And I'll explain that why in just a second. But when you get way deep in the money on a position that we've already put on and we've been watching since November, all the way down to the 320 strike right here. First of all, the bid-ask spread gets tough because now we're 6 points wide, $6 wide, 654 by 660. We're $6 wide on that trade. And I've mentioned this many times that if we could get these markets tighter on these deep in the money option contracts, it'd make a tough, tough rationale to say, oh, you should buy the stock instead of the option. But the stock has obviously got a 1 point wide spread almost every second of the day in Nvidia. But on the option contracts, you're really battling bid-ask spreads. So by even rolling up, you're now rolling and you're bringing a spread down to the floor. So here's what we're going to look to do. Quite simply, and we probably stay right in this expiration. I don't mind going out in time in order to do this, but we're still 300 days away. We're a little less than a year in this. 1 year would be the March 21st expiration date. That's 361 days. But just to preference it, let's stay in the same expiration and look at the concept of what we would be trying to accomplish. 320, that is our option contract. We would be buying that. So it's $661 option contract. And then we would roll up, and I seriously would, or I would bluntly just roll down until I saw an 80 delta. So now we're getting within a 1 standard deviation move all the way down to here, and we're still going. There we go. There's our 80 delta. So we'll probably do the 750 strike if we were to do this at this point in time. This would be a buy to close trade. And then we would roll up to the 750 strike and we would buy that one. Now, this option contract has a $2 spread as opposed to a $6 spread in the way deep in the money contract. And that's an issue. We're right about the trade, but we're going to have to figure out how to split that $6 and try to share that with the market makers on the trading floor. And one way to do it is by rolling up and getting into a better situation, a more heavily traded option contract. So we hit sell. All right. So right now we sold one NVIDIA position. We're going to have 2 of them on that trade, but we're able to, this would be in this situation, we're selling to close, but it won't let me do that. It's going to make it an open because it's not in this trade. And then we're buying to open the 750 strike. We're getting closer to the option contract where it's currently trading at. We're still going to have an 80 delta option contract. So we've still got something that represents the stock. It acts a lot like the stock. And we're going to take this money off the table. So on a 2 contract position, you're looking at $352 times 200. You're looking at bringing $70,400 off the table, but you still are in the NVIDIA position. But that risk goes away. There's no more. You're not going to lose any more. You cannot lose that $70,000 once you take it off the table. You still have the position on, but now it's time to adjust that. Take that market value out of the position at that time, take it off of the table, and then we will look to use that capital to add a new position, more than likely in a different underlying stock. All right, so let me see here. Do we have any questions? We do not have any questions at this point in time. So this is how we're going to address the fact in the NVIDIA that we had such a large capital gain on that position. Right now it's up over $200,000, and it was just a 3 contract position that we started to build in November of last year. All right. If there are no further questions, that's going to be it. We're short and sweet here on Options Guy TV. We're going to be back on Wednesday to look at the entire paper trade portfolio. Our SPX option contracts will go away. If we don't get down, we don't go down about another 20 handles here. Those contracts aren't really worth looking at. I would probably just sell my long put option in our long put calendar trade. Going back to the what if calculator. Probably just end up selling this long put option at the end of the day. It's trading for 47 cents. Maybe we can get our money back if we get a small move to the downside going into the end of the day. And this option contract's going to expire worthless. All right. Thanks for coming, everyone. Please click subscribe and ring the bell if you'd like to get all the alerts for Options Guy TV and everything on the YouTube channel at Tradier. And we'll see you this Wednesday at 11 a.m. Eastern time for the next edition of Options Guy TV. Thanks for coming, everyone.
All opinions expressed by Tradier Hub contributors are solely the contributors' opinions and do not reflect the opinions of Tradier nor its affiliates and or subsidiaries. You should not treat any opinion expressed by Hub contributors as a specific inducement to make a particular investment or to follow a particular strategy, but only as an expression of their opinion. The contributors' opinions are based on their own personal research, but neither Tradier nor its affiliates and or subsidiaries warrants its completeness or accuracy, and it should not be relied upon as such. Any trades or positions discussed or referred to by contributors may or may not be actual live trades or positions. Such information is not intended to be financial or investment advice. Tradier Inc. is the parent company of Tradier Brokerage Inc. Tradier Brokerage Inc. and Tradier Inc. are separate entities with their own products and services. Securities products and services are offered through Tradier Brokerage Inc. Tradier Brokerage Inc. is an independent subsidiary of Tradier Inc. All rights reserved. Member FINRA SIPC.